All right, you're all set to go.
Can you make Karindra co-host?
Yes, I will.
Thank you. All right, Holly, we can get started.
Thank you. Good morning, everyone, and welcome to this morning's meeting. I'd like to call the meeting to order. The time is now 9 a.m. And Stephanie, would you please take attendance?
You're on mute, Steph.
My apologies. Adrian Cochran will not be joining us today. Andrea Comer has not joined us yet.
I just let her in. So
Okay, thank you. We'll circle back to Andrea. Ellen McKitterick.
Present.
Good morning. Mike Soltis.
Present.
Holly Williams.
Present.
And Melissa Zyobron.
Good morning. Present.
Thank you. All right, we have a quorum.
Thank you, Stephanie.
Yeah, good morning.
good morning, Andrea.
Good morning. Thank you, Stephanie, and thank you for any members of the public who are joining us this morning. The first item on the agenda is approval of the May 23rd, 2025 meeting minutes, since we did not meet in June. And I'd like to ask the committee for a review of those minutes and ask if there's any corrections or discussion.
Motion to approve the minutes for May 23rd meeting.
Thank you. And a second?
Second.
Thank you. All in favor?
Aye.
Aye. Any opposed? Any abstentions?
Yes, one abstention.
Thank you. We'll note that. The motion carries. Now we're going to have the Spring Group, who's going to give us a presentation on the annual actuarial analysis.
Hi there, good morning.
Morning.
I'm going to share the screen now. Jump into our part of the presentation. All right.
You can see your screen.
Thumbs up. You can see the presentation. That'd be great.
Yes, we can.
Okay, great. Thank you. Okay, so the purpose of today's presentation from my side is to provide the results of the annual work that we do, calculating the projection for the following 3 years. That's what we've shown here, as well as showing the full year results from our perspective. I'll jump into that by starting with the full year results first, and then show you the 3-year projection as well that we came up with. Okay. So as it relates to the full year results with the fiscal year ending June 2025, these results are on an incurred basis. The numbers on the right-hand column provide what we had shown to you back in June, really to the board back in June. They represented, on the right-hand side, it represented 3 quarters worth of actuals and as well as the remaining 3 months projected. The numbers in the middle column are the new results updated to reflect actual experience all the way through to the end of the fiscal year. Overall, what the results show is that the fund balance starts off at $628.7 million. That's the fund balance at the beginning of the fiscal year, net of outstanding contributions and claims payments, net of the reserves. At the end of the 12-month period, the fund balance is expected is $641 million. So that is based on net activity of $12.3 million. This is about $1.8 million lower than what we had from last quarter, driven by slightly higher contributions and high investment income, offset by higher claims experience. So the big item here is the claims projected incurred claims are a little bit higher, more based on an increase in the reserve estimate. And it's offset by contributions being a little bit higher, investment income being a little bit higher. And I guess other expenses also just 0.1 million lower. So overall, the net activity for the period is 12.3 million. and that's how we get from the 628.7 million up to the 641. So positive net activity this year. When we look at the funding metrics, the fund balance is the fund position remains strong, because when we look at the funding metrics, we are below the target. As we talked about last quarter, you may recall, we said the adverse losses over 1 year versus the net fund. That number is getting closer to our target. And so we'll continue to monitor that as part of our regular work that we do throughout the year. Okay. With that, I'll move on to the next page. This page provides a graphical illustration of the results that I provided in the prior page. So again, you'll see the fund balance at the beginning of the fiscal year at 628.7 million. The numbers on the left represent the actuals. So the numbers on the right represent the numbers we had from last quarter. But overall, 628.7 million is the fund balance. Revenue was about 510 million. So these are the contributions plus interest investment income. Expenses about 497.7 million. And so overall, we end up at the fund balance at the end of the fiscal year of 641 million. Okay. Moving on to the next page. This page is provided, is a detailed page provided and to show you the detail. The intent was not to go through this during this meeting, did this part of my presentation in detail, but I'll leave it so that we can answer any questions as well, and you'll have it for reference later as well. So the second part of this presentation is to go through the updated 3-year projection. So we provide this in various forms throughout the year. So you may recall we've shown you graphical illustrations of 10-year projections as an example. For the annual work that we do, we provide the 3-year numbers. These are also shown in our annual report. So I'll walk you through that next. So what this table shows is the reported numbers for fiscal year 2025, which I went through right before this in the first column, and then the projection for the next 3 years in the columns to the right, for 2026 through 2028. Overall, what we see based on our baseline projection is that the numbers are positive, or we have net activity that's positive projected in the first fiscal year. And then in the next 2 fiscal years, the net activity is negative. So in other words, expenses are greater than revenue. Okay. Now I will highlight, as I always do, that the numbers are very sensitive to the assumptions behind this, and even a small change, especially when you're looking at the net activity numbers, can be magnified quite a bit, especially over a multi-year period. So I just want to point that out. In particular, we're looking at, as an example, claims of 500 million. So a small change in that number, either higher incidence levels, longer duration, higher average benefit amounts being paid out, as an example. Any of those items could easily move this number up or down, and that will have an impact on the net activity. So just for context, I guess, the net activity shown is relatively small compared to the fund balance. Okay. And also compared to the actual claims or contribution numbers. So it's, in other words, contributions and claims are in revenue, and expenses are relatively close in these scenarios. But in our baseline scenario, we do see that the overall fund balance is projected to decrease slightly by about 3% over the next 3 years. Okay. One other thing I wanted to highlight is in fiscal year 2026, we have an additional row here, transfer from operating reserves. So this represents additional reserves that were being held that is getting transferred back into the fund. And I believe these reserves are in respect of the administration expenses. additional funds that were collected or allocated in respect of administration expenses. I believe Dave will be talking a bit more about this as well. The other piece I'll just point out, when we make these projections, we're factoring in the number of things, number of elements into the projections. That includes how the population is going to change. So we collect data around unemployment levels, as an example. We also have reviewed historical incidence levels, duration, the weekly benefit amounts. And based on that data, we established updated assumptions, which we do every year. So we're basically refining the assumptions to reflect the most recent data. So all of that is baked into these numbers. In particular, with the claims number, that's a big part of the work we do, is projecting what the claims might look like. And we have also reviewed a number of scenarios and sensitivity levels around these numbers with the authority. So this is where we're at in terms of our baseline projection. You'll see other versions of this as we progress as well during the year and in the next few meetings, as we look at other elements of the program. But from an annual reporting standpoint, you'll see these numbers in our report as well. Okay. With that, I'll point out we've also provided the detailed version of this in this document. It also appears in our annual report, this exact same exhibit for your review. Yeah, no material comments on this my end at this stage. Covered up all the items. This page just provides a graphical illustration. One of the key items I wanted to highlight here is that even though we do see some negative activity in the following years, 2027 and 2028, and you can see that the fund balance is still over 600 million based on this projection at the end of those 3 years. The other piece of this is that expenses are expected to increase at a greater level compared to the revenue. So when you project this out longer, over a 10-year period, which we'll show you in future meetings, you can see how the net activity continues to can be shown as negative because it will continue to grow with these trend lines. So that's something we're monitoring. We looked at it previously as well, in particular when we had those discussions around the rate. So again, continue to monitor this, and we'll be providing several scenarios as we go along over the next several quarters. Okay. So that makes up the formal part of my presentation. Again, net activity for the period was about $12 million. The fund balance as of June 2025 is 641 million and continues to meet the funding metrics that we had established. When we look at the 3-year projection, the fund is expected to decrease by 3% over the next 3 years. So those are sort of at a high level the key points we'd like to make. With that, I'll open it up for questions.
Thank you for that presentation. Does anybody have any questions?
I do, Holly. Good morning. Sorry, I can't find my button for my hand
Oh.
raise.
That's all right. You go ahead and ask your questions.
Okay. Good morning. You mentioned an appendix in one of your slides, which shows all of the assumptions. Do you have the appendix that you could put on the screen?
Yes. Yeah. So it's in here. It's also in our report. So I'll just walk you through it, just to give you a high level. So we have a table here which goes through a lot of key assumptions, and then in addition, some of this refer to other tables. So we have like salary growth, incidence levels, duration, average weekly benefit amount, bond repayment schedule, etc.
Can you put it back on?
Can
you put it? Yeah, that's great. So I have some questions about the assumptions. Is Holly, is this the appropriate time for that or?
Yes, you can go ahead and ask your questions.
Okay, so I'm looking, can you point me out to the total amount of those covered? I see you are expecting an additional 30,000. That is from what was just passed in the last enacted budget. Is that correct for school
Yes,
staff?
that's right. Yeah,
And so you include that in your assumptions for the next 3 years?
yes.
Okay. And is there any, has there been any numbers or assumptions put together for potentially onboarding members of CBAC?
So I'm going to jump in on that just because I'm not sure that Harindra knows the state acronym. CBAC is the State Employees Bargaining Agent Coalition. No, we have not done any analysis to assess the impact of having the unionized state workforce participate in the program. Right now, just for those of us watching along at home, employees who work for the state who are not covered by collective bargaining participate in the program. For folks who are in unions, each union would have to negotiate in. So, and to date, none have done so. So we have not had
Is it-
any indication that that's going to be happening. We do have rules about how it has to be done on a prospective basis, and they'd have to come in at the same procedures, rates and standards. There's no discount for state employees, but
Yep, no,
no, we haven't accounted for that yet.
is it possible to request the consulting group to in fact prepare what that may or may not look like? As you probably know, and it's been in the papers, several bargaining units are voting against the offers that the administration has made. And so I'm wondering if this isn't part of their conversations that they're having behind closed doors. So I would be very interested to see what that looks like. I mean, I see 30,000 here, but it, as you pointed out, it's pretty significant. What is the process for us projecting those assumptions going forward, if in fact it's happening, which it could be, and we have no idea?
So we can absolutely work with Spring to do that. And we can probably lean a little bit on Holly's colleagues at OPM for some of the salary numbers. And we can look at, I'm just trying to think if any of the states have a fully unionized, have their state employees participating in programs yet, but we can absolutely look at that. One of the things that I think is important to just bear in mind is if they come in, they would also start paying contributions. So
No, definitely. Yeah, that's why I
yeah.
think it's such a yeah, you got to get it on both sides, no doubt.
Yep, we can absolutely do that. We'll have to sort of talk about what else has been on their plate and if we can get it done before the August meeting, but we can actually work on that.
Great. Thank you. Thank you, Holly.
You're welcome. So I just want to have ask some clarifying questions. The investment income, I know that there's some dampening of that. Oh, I see it right here. So our out year projections in this analysis align the investment rate of return to the historical norm that we have seen for the STIF. Because we've had the past few years, there's been an anomaly, right? Where we've had higher rates of returns high fives. And so this projection is normalizing kind of that investment rate of return back to what we have historically seen.
Yes.
That
Yes.
certainly
Yeah.
looks to be the case. I mean, we do get this from the, I guess, the OPM, Office of Policy Management, but apologize for that. But it does look like, other than for fiscal year 2026, where we do have a higher investment income rate of return, beyond that, it looks like the number is a lot lower. So yeah, absolutely, looks like that is the case.
Okay. And the other thing was, I just wanted to say, just for the purposes of the meeting, that as expenditures grow at a faster rate than revenue, that's why we're seeing that fund balance kind of get eroded a little bit in the out years. And so we'll really have to monitor the health of the fund balance as we move forward, as there's, changes in the covered population. So I appreciate you putting that graph in. I don't recall seeing it before, although you might have had it. I thought that was very helpful and was consistent with what we've seen in the past actuarial reports. One thing I was going to ask was, I know in the past we've seen a sensitivity analysis that has shown like a 1 or 2% change in the incurred claims and what that does with regards to the fund balance relative to what is reflected in the actuarial report. Is that something that, well, I guess we'll see that when we do our evaluation of the contribution rate. Or okay.
Yeah.
All right. So
we'll be providing
I'll stay
a number of
tuned.
sensitivity scenarios, and we have reviewed some of this already, but yes.
Okay.
We'll be providing.
Because I think we've already seen the incurred claims. If I'm correct, they've already eclipsed that like 1%. Is that true? We've already started to see it kind of tick up greater than we had, or consistent with what we had projected, which is what we want. We want those claims to go up because we want more people availing themselves of the benefit.
Yes, yeah, we have seen the claims rise pretty fast in the last year, especially, right? Or even the last 2 years, much more than 1 or 2%. But we do think also that at some point it will stabilize as the program matures. And even though, one thing I will just show you this. So we do have incidence rates projected to increase over the course of the next 3 years at about 2% a year in total. So it's about 4.8% right now. So just under 5% of the population is expected to have a claim. That's a good way of looking at it in a given year. But we do expect it to continue to increase. But at some point it will flatten out. We think it's around 2028 is kind of what we pegged it at. And at that point, the incidence levels should be somewhat more stable other than external events.
Okay. All right. That's helpful to know. All right. I actually didn't have any other further questions. Does anybody else have any questions? Just scrolling through. I don't see any.
I have a quick
Oh,
one.
yeah.
I just didn't want to hog the time, so I appreciate it. I'm going back to that main assumption appendix. I see that also another assumption is the pending claim approval statistic of 50%. I'm just curious. I know it says here it's based on historical activity, but do you guys run assumptions with 5%, 10% more in utilization? I'm just curious to see what those numbers may look like. And this isn't something I need, by the way. And even the previous request, I'm not looking for that info in 1 month. I'm just kind of talking as a more newer member of the subcommittee.
Sure. That's
Yeah.
actually the sensitivity analysis that Holly was talking about.
Okay. Okay.
Which, that's become our shorthand for it, but where we really do look at what happens if claims, we have more claims coming in. What sort of a spaghetti chart, sort of what that looks like and how that affects things. So that's definitely something that we have been doing because we are still a relatively new program and the world of paid leave is relatively new, which makes it difficult because assumptions based on pre-2020 experience in other states is of very limited value. So that's why we've been doing those things.
Great.
Yeah.
Go ahead.
Oh, so I was just gonna say, like, any projection that we would provide, it comes with the underlying kind of caveat that it is based on a set of assumptions, and the reality is actual experience in any given point in time. There's a lot of variables that impact. As an example, that one item, which is incidence levels, right? Investment income is another one that affects the fund balance, amongst all of the other assumptions that go into it. So it is very much part of what I would preach is, look at the sensitivity, understand the range of how these numbers change and how easily it can change. Like especially when you think about it. From our perspective, we're kind of advocating to look at it over the long term, look at the fund balance, make sure it's sustainable over the long term. And so when we were even looking at the rate setting process and all of that, we were looking at it over a 10-year period. Because, you want this program to last, you want it to be, from a fiduciary standpoint, be sustainable, and make sure the funding is sustainable, especially given that there's a cap on the rate. So yes, it's absolutely, I guess what I'm trying to say is it's absolutely makes sense to look at all the sensitivity scenarios, understand the potential. And then also the other part of it that I would always say is continue to update the projections and all that as we get more and more experience. So with emerging experience, we revisit the projection for the year as an example every quarter, and we'll continue to do that. So if we have better experience or worse experience, it's reflected in the work that we do and in the projections that you see.
Great. Very helpful. Thank you.
So,
Thank you for your responses. Are there any other questions this morning?
I have
Oh,
one.
Mike, I see. Yep, I see your hand up, Mike. Sorry, I
Thanks,
just had to
Holly.
scroll all the way to the left.
Good morning, Harindra. Thanks for your presentation. Just one question: to what extent does the state of the economy affect your projections? In other words, if in the next couple of years we have a growing economy, how would that affect the numbers? And the other side of the equation, if we had a recession, how would that affect your numbers?
good question. So it does affect the numbers a fair bit, because of the various elements again involved. As one part of it, you have a growing economy, higher employment, right? It means that we're collecting more from a contribution standpoint, but also means more people are working. So there's a greater chance people will take leave, have babies, and all of that, and need the program. So greater number of people impacted by the program. But also growing economy means potentially a different, if interest rates decrease, as an example, investment returns may also decrease, and so that could be a factor. You may have so I guess where I'm going with this is the numbers could be bigger as the economy grows, especially if you have higher working population. So basically more people covered. Now, a recession is kind of an interesting one, and depending on what caused the recession, whether it was COVID or just like the 08, 09 recession, it could be different. There could be a different effect. Unemployment, so increasing levels of unemployment, people being terminated can mean greater anti-selection, greater risk of people going on leave or trying to find a reason to go on leave and get some more income that way. Or so that could mean higher claims in that scenario, right? And at the same time, potentially decreasing revenue because less people are working, you're collecting less from a contribution standpoint. So that could potentially have an adverse effect. If it is for a reason like COVID, you may also have higher stress levels on in terms of own health claims or people taking time to take care of family members, which could also be an additional factor on top of this that could impact basically increase the claims in addition to anti-selection and other things that I was talking about. Again, because of the nature of the program, because health is involved, family members involved, a pandemic type situation could mean additional claims. It's kind of where I'm going with that. Recession could mean anti-selection, again, higher claims, decreasing levels of revenue, net activity being more negative than perhaps we're seeing in this scenario. Growing economy, I think in general, more revenue, but also still more claims. So less of an impact. And depending on if that means a greater interest rate or a lower investment income level, there could be a smaller impact on that side as well. So Mike, I know it's kind of hard to be like, this is exactly what's going to happen, but there's a lot of factors at least that I can talk about and kind of what that will do to the numbers.
Right. And thank you for that. So your projection for the 3 years, does that include any change to the current economy? I mean, have you projected the economy will grow or decline in your 3-year projection?
So no material effect, like especially nothing that dramatic. I'll show you one of these tables right here. We do show the unemployment rate assumption. So starting with more like a current assumption, looks like we're projecting slightly higher level of unemployment. So that's one piece of it, but not like the unemployment levels changing dramatically. That's not built into this baseline set of numbers. And to some extent, you can see just based on the results, the revenue and income, the income and expense is staying relatively flat over the course of those 3 years in our projection. So we're not necessarily like you don't see the numbers bouncing around a lot. It's relatively stable. I go back to this graphic. Yeah. So no dramatic economy changes or changes in the economy built into this. We do look at it when we look at some of the sensitivity scenarios.
All right, thank you very much. I appreciate that. And I do like this slide, although it gets me a little worried when I project out to 10 years.
Yes. Like if because we do look at this numbers when you project it out 10 years. And we have looked at it in prior meetings. It is negative and a bigger negative numbers. Yes, we'll be showing some of that to you in future meetings.
All right, thanks, Harendra.
Sure.
Any other questions this morning? I don't see any. All right, thank you so much for your presentation this morning. Always informative.
Thank you. Thank you.
All right, so Dave, you're on deck. We're going to go through the finance and accounting policies proposed updates.
Okay, thank you, Holly. Good morning, everybody. All right, changing gears a little bit, we're going to talk about policy. So let's see, let's get that up on the screen. Everyone can see, I hope.
Yes,
We can see your
it.
screen.
Thank you for the verification. Okay, so for those of you who have been here before, you might remember that on an annual basis, we do review the finance related policies and determine if any of them need to be updated based on what was happening during the year. So that's what we're doing today. We're looking at the finance and accounting policy, and we're also looking at the credit card policy as well. So the good news is that we really don't have a lot of changes. Policies have been in effect for about 4 or 5 years now. So there really haven't been many major changes that are warranted for this year. So the major changes or updates are as follows. Number one, we documented in the policy of the now annual practice of redesignating any operating fund surpluses into the contributions. That was what Harindra was talking about a few minutes ago when he pointed out the new row in his analysis. And so for the new fiscal year 2026, that'll be north of $14 million. That dollar amount was the accumulation of several years. So we don't expect the dollar amount to be that large in future years, if there's any at all. But we did want to document that as a matter of policy going forward for the authority. So that was the first one. The next one is we have an additional reporting requirement now with the State Elections Enforcement Commission, or SEEK. And so they're responsible for contractors and making sure that contractors are adhering to the rules, because contractors are prohibited from soliciting and making certain campaign contributions. So that commission needs to know who the contractors are and who we're doing business with. So we let the commission know who our contractors are that we're doing business with over $5,000. And if there's any changes, we're required to let them know on a monthly basis, which we do and have been doing for quite a few months now. So we wanted to document that as a reporting requirement for the authority. The last major item was defining reserve percentages for both contributions and benefit overpayments. I'm going to circle back to that in a minute and show everybody exactly what that means. Before I do that, I just want to go to the other clarifications. We clarified that responsibilities or duties can be reassigned by the CEO or the controller, because sometimes during the year, responsibilities change or job titles change. And so we just wanted to reflect in the policy that that happens, because we didn't want to go back to the policy and have to update it every time something like that changed. So this way, it encapsulates all those kinds of changes within the policy. And the last item was we identified the contribution refund process as a policy. We're doing that because these are for contribution refunds that can't be refunded on the original platform that they were paid, typically because they have exceeded the time frame to refund them on that platform. For example, if you pay, if you do a batch payment and that money comes in through Bank of America, there's about a 2-month window which you can refund the payment. If you make a payment directly to us via the website, that payment, if it's done through your bank account, there's about a 6-month window. If you do it on a credit card, there's a longer time window, about a year or two. Sometimes it depends on the credit card you're using and the rules thereof. So after those various timeframes, the authority would refund the payment back to the employer, and then the employer thus is responsible for refunding the contributions back to the employee. So we just wanted to identify and define that as a policy that's happening. Okay, circling back to our reserve. This is percentages we show for basically what would be if we were in private industry for our reserve for doubtful accounts or accounts receivable. And you see on the second column from left, there's 3 percentages. Those haven't changed. Those were in the policy before, and they were always the same: 90, 95, and 100%. So there's 3 buckets, obviously. And the first bucket for the allowance of doubtful accounts is what we call CTPL, CT paid leave. Those still with the paid leave or with a representative of paid leave. The second bucket is allowance for doubtful accounts, FRV, and that stands for Fund Recovery Vendor, which is now TSI. So those tend to be older, which is why the percentage goes up. And then finally, the bottom one is the reserve for uncollectible accounts. It's been deemed uncollectible, so thus we reserve it at 100%. And if you look at the 2 columns to the right, there's 2 types of items that can be reserved for. One are contributions. And so if there's contributions that are less than 5 months old, then we reserve them 90%. If it's between 5 months and 16 months, then those items are provided to the fund recovery vendor for them to work on. And so we reserve 95% of that. And then anything beyond that time frame, greater or equal to 17 months, is deemed 100%. So if we actually do get anything, it's unlikely, but if we do, it'd be a recovery at that point. The last column for benefit overpayments, it's basically the same philosophy, but the timeframes work differently. If it's less than a month, or the collection owner is the benefit administrator, i.e. AFLAC, then we reserve 90% of it because we're still actively working on it, or AFLAC is on our behalf. When it's between 1 and 11 months, the collection owner switches to the fund recovery vendor, then we bump up the reserve to 95% because, again, they're working on it. And then again, the final bucket, it's 100% if it's greater than 12 months, or it's a misrepresentation. So if it's a misrepresentation, we don't wait for the 1, 2, 3, 9, 10, 11, 12 months. We reserve 100% of it right away because it's deemed unlikely that we'll collect anything. Or the collection owner is still the benefit, is not the benefit administrator. So you might be sitting there wondering, well, why would AFLAC still have benefit overpayments that they're working beyond 12 months? And the most significant answer to that is because of payment plans. AFLAC will set up payment plans with those people who did have a benefit overpayment. And so they'll set them up on a multi-month payment plan. And as long as the individual is still following that payment plan and making the payments, then we'll reserve it for the lower percentage at 90% instead of 100. So that's how the reserve policy works and is documented. Moving on to the credit card policy, the updates we made were the following. As most of you know, we are using bill, spend, and expense now. And so for credit cards, and that has made the tracking of credit card transactions much easier. And so we are actually now able to integrate the actual transactions into the bill platform, and that uploads directly into QuickBooks. So everything is electronically done now through a workflow. That was not originally envisioned in the policy. Well, the good news is we're doing it now, and it's a lot more efficient and easier and accurate. So we wanted that to be reflected in the policy. Like I just mentioned, that flows into the second bullet, the approval policy. Now that it is going through the bill platform and the and ultimately up to QuickBooks Online, that aligns with our accounts payable approval process. So we just wanted to align it with the both and make a policy that the two are the same in terms of how it's approved and who's approving it and the dollar amounts thereof. So we align that. And then the final one is that there's a monthly reconciliation now instead of expense reports. We originally envisioned there being expense reports, which I like to think most of you are probably familiar with. The way the bill platform works, it takes the individual charges and allows the appropriate person to approve them. So you don't have to look at your credit card statements and put them on the expense report, take a picture, submit it. It's all done automatically now. So it's a lot easier. So we just wanted to reflect that's how, again, how that workflow is working. And then we just had some clarifications on the authorization of credit card insurance, who's doing it, and the process thereof. It's still the CEO, Erin, ultimately has the responsibility for the authorization of credit cards. And by the way, we don't hand out credit cards to many people at the authority. We currently only have 2 out there right now. So we are somewhat on the conservative side in terms of having credit cards out there. And then the final item that we clarified in the policy was the Connecticut tax exemption. If you have a corporate credit card, you need to be aware that as a quasi-state entity for Connecticut, we are exempt from paying sales tax. So you should have the exemption certificate on you so we don't unnecessarily pay sales tax for any of the expenditures of the authority. So that is the policies in a nutshell. I'll take questions at the time. Melissa, I see you figured out how to raise your hand. So go for it.
Thank you. I appreciate that. So you did answer one of my questions. One of my questions was going to be how many employees of the authority have these credit cards. I guess they work because of our quasi status, like a P card would under regular state agency use. Is there a policy over what items can be charged and things like that? Like, is there a deeper dive into the credit card policy on what constitutes an authority purchase?
Oh, yes, that's actually a different policy, and
Okay.
I could certainly send that to you because we have a travel and business expense policy
Okay.
for all kinds of expenses, whether you use I'm going to stop sharing now just so I could see everybody. That covers any of the type of expenses that are business appropriate. So we could certainly send that to you. If you have any specific questions, I can answer them now if you'd like.
Well, yeah, I guess I'm just curious, on the earlier presentation, it showed the expenses of the authority increasing by 4% every year. And so I guess my curiosity is what has been the baseline of these expenditures that are being charged to these accounts? And is there growth in that expenditure class as well?
Sure.
And I don't need detailed
Yeah.
detail. These are just over, again,
Of course.
first time questions.
So going back to the previous presentation, our expenses are our own staff. So we have grown, and so our PS line has gone up. And then the expenses with our third-party administrator, AFLAC, will go up when the new contract takes effect. Actually, they go up now because there's a built-in increase with this year and next year, and then the new contract will take effect. So those are really where you see our expenses. In terms of credit card usage, we generally speaking use our credit cards when we have travel for either training or meetings of paid leave states. So there's, for example, a NASWA, National Association of State Workforce Agencies event that we'll be going to. We use the credit card for the plane and hotels. Beyond sort of travel expenses such as that, we mail things, we print things. So there may be a credit card expense at the post office. I feel like I feel like those are the ones I've been approving lately are because we're mailing packets of things out. So we don't really use the credit card for a lot. Most of our vendors we pay directly, so we're not paying on the credit card. So they really are those sort of incidentals.
And I noticed on some of the background reading I was doing over the last few weeks, I think I saw cell phones and some other things for staff. I'm just curious, you know, because you guys are all remote, right? There's no hard office. We're not paying for things like paper or printing or reimbursing electricity costs. Like how do we deal with those sort of unique situations that are born from the authorities, you know, the way you operate?
Right. So we do not pay any sort of money to our staff in connection with sort of the fact that they're working from home. We do have drop-in space at 450 Columbus. And so we have access to printer, computer, so tend to encourage folks to use that if they have large printing, or we'll use the DIS print shop for significant print opportunities. The fact that we are fully remote means that we don't pay rent. As a quasi-public agency, if we had a fully built out space other than the drop-in space that we use, we would have had to pay rent. But it's one of the primary reasons why when everyone started talking about going back, we really looked at whether that made sense for us because we've been operating very effectively and efficiently without that. So really our reimbursements for staff are really primarily mileage. Cell phones we all have. They are useful not only for communication purposes, but also they act as hotspots so we can ensure everybody has Wi-Fi. That is a essential of modern living. And so they can't get their work done if they don't have Wi-Fi, so they have their cell phones for that. Everyone has laptops. But, you know, generally speaking, our OE expenses are pretty low because we don't have that obligation to pay rent
Right.
or build out anything.
Thank you. Appreciate it.
Any other questions? Not seeing any. Thank you, Dave, for running through those policies with us this morning. And I know now that you're gonna.
Can I ask one more item? I'm sorry.
Oh, no, that's okay.
Regarding the policy,
Yeah.
I see Erin looking at me, and so I've been working long enough that she telepathically sends it through the screen to remind me of the following. So typically with policies, we also go to the appropriately titled Personnel and Policy Committee and present it to them as well. Now that committee meets bi-monthly. So they're not going to meet in the beginning of August. They're going to meet in the beginning of September. So we would go to them in the beginning of September and let them know about the policy and then bring it to the board and ask for them to vote on the approval for public comment. And if we want to go that route, then absolutely we will. If anyone here thinks that perhaps waiting the extra month is too long, then we would ask, and since some of you are also on that committee, we're asking if you think it would be appropriate that we would go directly to the board at the board meeting next month and discuss it at that time, because obviously everybody on the committees is on the board. But if you think, no, we should definitely go to the P&P committee first and we'll wait the month, that's fine too. I'm just throwing it out there as a possibility.
So, this is Mike. Is there an urgency that would warrant going directly to the board without going to the policy committee?
No, there's no sense of urgency. None of the changes are, need to be formally approved right away.
Well, I'm a big fan of regular order whenever possible, so that's
Okay.
just one person's view.
Okay. Does anybody else agree, disagree, have a strong feeling one way or the other?
I agree with Mike, especially if there's not some urgency or some procedural issue that would require us to accelerate our approval process. Then at least, I know it's kind of the same people, but then at least, you get a little bit, if somebody wants to weigh in after some time reviewing it, then they have more than one other opportunity.
That's very true. Okay, then we'll go to the Policy and Personnel Committee meeting in September. And so Michael Caesar will have to make room for me at the virtual table.
I may have some additional questions. Is it more appropriate for me to email those or just give you a call, Dave?
Well, you can do either. I will just say, if you do email, just please email me directly, not the whole committee, because as you may be, well, you may be aware of this, so I apologize if I'm being obvious here, but you will create, I forget what the legal term is, Erin will tell me, but you will create an impromptu meeting by copying everybody. And so we don't want to do that. So you can email me directly, call me, a private Teams meeting, whatever you want, either way.
Great. Appreciate it. Thanks.
Okay.
All right, thank you. So, okay, so this doesn't need a vote or anything. It'll get transitioned over and brought up with the Policy and Personnel Committee. All right, so that's helpful. And we're now going to go through the update on the budget review of spending to date, which is also you, Dave.
Okay, thank you again. All right, so we are going through the results of June, which is fiscal year end. We made it through another year. And if I could share the right item. Okay.
Your screen.
Thank you for the verification. Okay, so like I mentioned, we are going through the results for the month of June and year to date too, for that matter. So our results for the month of June were a negative $1,376,000. That did create a positive variance of $178,000. Our expenses for the month were $1,461,000. That is more than usual, and that's because typically at fiscal year end, our vendors catch up and pay us for any back billing they have, because typically it's fiscal year end, and they know that next fiscal year is a new budget, so they don't. We don't want any budget issues starting out the gate with the new fiscal year. So, for example, our outreach expenses were $329,000. That includes expenses for our community engagement coordinators, and we had some back billing that we paid for, and most of them pay through the month of June. Actually, we only asked them to pay through May. They're usually about a month behind, but many of them pay through June. So there was that. Our payroll and related expenses, that was $681,000. That those items, payroll and benefits and pension overhead, continue to be our largest expense. The contact center continues to come in at $132,000. We did have insurance expense this month of over $118,000. That was our annual payment for our insurance premiums. We paid most of them for the upcoming fiscal year. There's one more you'll see in July that we didn't get a final invoice on until July. So you'll see that next month. Other significant items were IT consultants of $42,000. IT hardware was $40,000. That is laptops that the authority buys. We have a policy where every few years, if you have a laptop that's over a certain lifetime, that will get a new laptop. So it doesn't, so it's not too late and it goes kablooey and then you lose everything and then it's harder to get it. So we try and be proactive with that. And then there was also our quarterly grievance adjudication expense that came in at $37,000. That's for the quarter. And that continues to be on the low side as our appeals volume has been relatively pretty low. So those are the significant items that made up the expenses for the month. So year to date, our activity was almost $1,755,000. Just under a $160,000 negative variance. As a reminder, it is negative because we didn't transfer $5 million into the operating reserves because we had enough money in the operating reserves to cover expenses. So we kept it in the contribution fund where it earns interest. On the other side, as additional information, our expenses for the year were just over $13.9 million, and we had a $4.5 million positive variance for those expenses. For our bond activity, we paid $31,000 for bond money this month for fund recovery work that we were doing. That was an over $68,000 variance. And for the fiscal year, we actually had a $260,000 positive variance compared to the bond money that we had expected to spend. So we spent just under $940,000 for the year. That leaves us with $1,446,000 in bond money. Next year, we'll be using that for fund recovery and some other items related to the contribution system, including some website improvements. So stay tuned for that. Moving on to contribution activity. Our activity for the month was a negative $37.1 million. That was a negative $5.4 million variance. As most of you have been hearing me say over the past few months, the biggest driver of that was for benefits, because as Harindra pointed out at the top of the meeting, the benefit payments that have been going out were larger than expected and larger than what we budgeted for this fiscal year about 14, 15 months ago. So that's why there's a negative variance. For the rest of the month, there were positive variances all around for contributions, which came in at just under $537,000. Fund recovery efforts continue to be better than budget. Investment income at $2.1 million, slightly under what we budgeted because the benefit payments were higher than expected. There was less money going into the contribution fund. So even though the rate at which we're currently earning at, which is 4.4%, is higher than the rate at what we budgeted at 4%, the base of what the interest we earned it on was smaller than what we budgeted for. So that's why this is coming in slightly under. That's just for the month of June, because as you can see, we were almost $3.9 million ahead of budget for investment income for the entire year. So again, the investment income is coming in at, it's been about 4.4% for quite a few months now. Holly had indicated before we were at a high of 5.4%, and that's what it was at the beginning of the fiscal year. It's since dropped down, and so we'll see what happens in the next few months. Year to date, our activity was $19.8 million. That was a negative variance compared to $43.2 million. Again, the biggest driver of that is that benefits paid were higher than compared to budget. We're seeing a weekly run rate now of about $9 million a week for the month of June. That's slightly up from the prior month of May of $8.9 million. We are seeing those benefit payments increase. And in fact, our most recent week of payments in July, we set a new record for $9.5 million of benefit payments. So as Harinder said, we are obviously monitoring that closely. All the other items in the contribution budget for the year had positive variances, including a contribution and our fund recovery efforts. And again, you see the $5 million here because we didn't transfer 1/4 of administrative fees over. And so that's why that's positive. And at the end of the fiscal year, on a cash basis, the fund had $585.8 million. Now, Harinder had indicated that his schedule had $641 million. And as he also indicated, that is on an incurred or accrual basis. On a cash basis, we're at 585.8. What's the biggest difference? The biggest difference is that for this current quarter, actually as of next week, the contributions are due without penalty on July 31st. So the bulk of the contributions come in July. And so spring on an accrual basis accrues those contributions in July, because on an accrual basis, therefore the quarter, they're applicable towards the quarter ended June 30. But since we're on a cash basis, we obviously can't count money that hasn't come in yet. So that's why it's 585.8. Just in case anybody was wondering about the difference there. And our balance sheet, we have about $604.6 million in assets. The biggest one continues to be the money in the short-term investment fund account. Like I said, it's earning 4.4%. We do have continue to have $17 million in the oppressed account at Aflac for them to pay benefit payments. And so in terms of other assets, we do have some fixed assets, and we do have the operating fund north of $14.9 million. We will be redesignating and transferring most of that over into the contribution fund in July. In fact, we've actually already done it. And on the liability side, our liabilities continue to be the bond funds payable. We actually did make our third bond payment in the month of June. So 3 down, 7 to go. So we've got $11.2 million left in principal towards the bond payment. No projections this month because we're at June. So nothing more to project because I have the actual results. But that's what's going on financially at the authority. I'm happy to take any questions at this time.
I don't see any questions. Thank you, Dave, as always, for walking us through how we close out this fiscal year. And I still don't see any questions. So is there any, that concludes our business today. Is there any old business anyone would like to discuss? No. Any new business? I don't see any. All right, so then may I have a motion to adjourn?
So moved. Second.
Thank you. Thank you. All in favor?
Aye.
Aye.
Aye. Any opposed? Any abstentions? All right, the motion carries and the meeting is adjourned at 10:09 a.m. I hope everybody has a wonderful weekend.
Bye-bye.
Thank
Thank
you.
you. You as
Thank
well.
you.
Thank you, everybody.
Take care.